Good morning, Scott. Thank you so much for joining us from New York City. How are things looking there? How is the CV19 looking there?
Well, good morning. Well, I should say good morning, and thanks for having me. It's getting better. New York City is one of the areas that got hit first in the U.S. Really hard, as you know, and then now the virus has moved its way down to the south and the west of the country. New York is coming back. It's going to be a little slow. It's going to take time, but it's coming back.
You talk about looking back, but let's look ahead, Scott. Right now, the thought leadership in the market is with the FAANGs, as everyone knows: Facebook, Amazon, Apple, Netflix, Google, right? But
yes,
they were not the original tech companies in America, right? Who were the original tech companies in America?
Yeah, the original tech companies in America were industrial companies. People forget about that, and it's funny when I look at the FAANG stocks, they add up to about $7 trillion in market cap, or a little bit more right now. Industrials add up to a grand total of about $2 trillion in market cap, which is a lot by historical measures, but comparatively is pretty small. So I think people have long forgotten that industrials are the original tech stocks. Amazing innovations around transportation, aerospace. The entire aerospace industry was developed by industrials. The electric infrastructure that we have around the world was originally from the industrial companies, and of course it's farm equipment from companies like Deere, and construction equipment from companies like Caterpillar and Komatsu. These were the original tech companies in not just America, but around the world, and I think have long been forgotten.
Scott, in the 1920s, if a company made it to the S&P, they spent almost 60 years in it. Now it's down to 20 years, and it's projected to go down to 10 years. What accounts for this rapid turnover now? Is it because of technological disruption only?
Yeah, well, it's a little bit of a lot of things. We wrote in our book, Lessons for the Titans, that the pace of change is so rapid right now that you're correct, that the average company in the S&P 500 is expected to last certainly less than 20 years, and many folks do say 10 years. Disruption has gone like this, of course, and that certainly plays into it. There's a lot of shareholder pressure to break up or merge, and quite frankly, the companies on the other side of disruption are failing. So, the market's consolidating down, as I mentioned, the market caps earlier, to a few select names, and that's a little bit scary for the market overall. But yes, the tenure of the average company is shortening by the day.
It's also said, Peter Drucker, a famous management theorist, said that culture eats strategy for lunch. How important is culture in order to build an enduring business that survives 20, 40, 50 years in the S&P?
Well, culture is critical because it allows the repeatability of success as leaders change. So, when you think about the challenges that GE had, for example, over the last 20 years, and more explicitly over the last 10 years, the culture of the company started to degrade meaningfully once Jack Welch moved aside and Jeff Immelt took over. Once that culture really started to erode, as the leaders in each of the businesses changed over, the business performance started to degrade materially. And we've seen that over and over and over and over again in the industrial world. And of course, we've seen it outside of the industrial world too. Culture is critically important. It's very hard to build culture. It takes years. I think companies try to do it overnight. They try to just throw some buzzwords around it and say this is what defines us. But in effect, what we found is that culture is something that takes a long period of time. It starts at the factory floor or in the cubicles where software is being written and works its way back up to the C-level group, not the other way around. It doesn't start at the top and work down. It works at the bottom and moves up. And it is absolutely critical to the long-term success and sustenance of the entity overall.
Scott, let me go through two examples in your book, which I found fascinating. India has a lot of small and medium enterprises, very few companies of the size and scale of, say, Google or Apple. So we'll stick to the smaller companies. The first one that caught my attention in what you mentioned was a company, I hope I'm pronouncing it right, TRANSDIGM. Is that how you pronounce it?
Yes, very close.
Right. In the book, you talk about the company going from $1 million to $1 billion. What was the secret sauce that they had? And what did they do? Can you tell us what they did?
story. In our book, we selected 11 completely different stories of success and failure. We selected those 11 out of really hundreds that we could have written about, and more explicitly, probably 100 that we knew intimately. TRANSDIGM and Roper are two of the feel-good stories in the book, in addition to Honeywell's another kind of feel-good story. But TRANSDIGM and Roper were very unique because the companies were built out of reinvention, out of a bold CEO who came into the entity when it was relatively small and said, let's redeploy capital in areas that are interesting to us, that earn high returns, and let's do it in a repeatable fashion over time, generate cash, pay down that debt, and rinse, repeat, if you will, over time. And then, of course, make those businesses better once they bought them. TRANSDIGM is a little bit different than Roper in that regard, that the businesses that it bought were incredibly niche, very high margin, largely forgotten by the entity that sold them, ignored for many years. TRANSDIGM could come in, put a little bit of capital into it, automate the factories, invest in the businesses, make them better, and created just a tremendous amount of value over time. Really, when we talk about value creators in America, so much of the focus has been on, like you said, the giant entities, the Googles of the world, and they deserve all the credit they get. However, people have forgotten, they stopped talking about the Berkshire Hathaways of the world, and then all the smaller companies that are more like a Berkshire Hathaway should be like a TRANSDIGM and a Roper. Great examples of that.
The business line of TRANSDIGM is what, and what was the niche that they found so profitable?
Yeah, aerospace is where TRANSDIGM has its growth focus. Obviously, aerospace is out of favor right now, but over time, aerospace has been one of the most exciting growth markets in all of industrials for a very long period of time. And the story really around aerospace growth, as you well know, is around emerging markets right now. It's really quite special. I mean, post-COVID, at least, we hope that growth comes back, and it should. TRANSDIGM saw the growth rates there early, but they also saw that there were certain products like seatbelts. I mean, you think about a basic seatbelt in an airplane, you don't think much about it, but very hard to get certified as a seatbelt supplier. Once your seatbelt is installed in a plane and you need replacement seatbelts if one breaks, et cetera, there's really only one place to go, and that's TRANSDIGM. So they make lots of different components in the airplane. I love using seatbelts as an example. Of course, my colleague Carter Copeland specifically covers the stock and does a wonderful job. But the seatbelt, I think, is a great example. Incredibly high margin, solid growth, and been an amazing business for them for a long time now. And there's lots of different niche products just like that. And
so the whole hypothesis that spare parts should be profitable, but not necessarily cheap, right?
Yeah, that's exactly right. I mean, they came in and of course they asked to be compensated for the niche function, and let's face it, I mean, TRANSDIGM has to hold the inventory. They have to make small batches of products, perhaps for an airplane that barely flies and may only need 1 or 2 spare seatbelts a year. And so they'll charge a fairly substantial premium for that product and earn a nice return on it. They've even taken some criticism for how much money they make. But the reality is that somebody else could come in and compete against them, and just doesn't make any sense to do that. So they've got a wonderful market.
And also the fraction of the cost of the aeroplane, these spare parts are small change. So people will pay for the reliability that they offer, right?
Absolutely. It makes very little sense. And just think about, the airports all over the world. I mean, if you really want airports all over the world having warehouses full of small niche spare parts, whether it's for the laboratory or for the luggage racks. I mean, it just doesn't make any sense at all. So I think the function that they serve is quite needed and makes a lot of sense.
Part of that business strategy was what you call value-based pricing. Can you explain that to us? What does that mean, and how effectively can it be used?
Yeah, I mean, TRANSDIGM didn't invent value-based pricing. I mean, value-based pricing goes back quite some time now, and I think, it used to be when a product was invented or when a product came to market in America that the company would take the cost of that product, and let's just say it costs, $1, and they would decide what kind of a margin they want to earn on it. Let's say they wanted to earn a gross margin of 50%. They would say, okay, well, I'm going to charge $1.50 for that. for that product. That's that's the old style. Most of our companies now have moved more towards a value-based pricing, which is really has absolutely nothing to do with what the cost of the product is. It has everything to do with what the value to the customer of the product is. If the customer is willing to pay $2 for that product, why charge them $1.50, for example? And I think most of our companies have found over time, and I think TRANSDIGM has done a better job than pretty much anybody at this, but most of our companies have found over time that the 80-20 rule holds effect, that about 20% of your SKUs generate around 80% of your profits. The reason behind that is really around pricing and around the value that the customer sees in that actual product. And so if you're TRANSDIGM, let's just say the same product, for example, costs $1 to make. If the customer is willing to pay, $5, they don't want to hold the inventory of it. They want it if the seatbelt is broken, for example, and they need it immediately, or that plane is out of service more than a day, et cetera. They're willing to pay a premium for that, and and that premium could be rather large. So that's the premise of value-based pricing. It's broadly used now. There's certain companies that do it much better than others.
Scott, a lot of these companies, TRANSDIGM and Roper, were built through inorganic acquisitions. The management theory of the 60s and the 70s said the company should grow organically. Has that now been changed or re-rated by Wall Street? Acquisitions?
Yeah, well, one of the things we really focus in on the book is not being prescriptive in the context of saying you must do acquisitions or you must invest organically or you must buy back your stock or pay back a big dividend. What we really say is that each company has an opportunity set that is unique. And if you're Oracle, for example, or Microsoft, you may have tremendous internal opportunities, investment opportunities, and that you should be deploying capital into. If you're TRANSDIGM and Roper, it might be a combination of internal investment and external. And I think the growth by acquisition stories, which explicitly really for us, Danaher was kind of the grandfather of them all, if you will, if you exclude Berkshire Hathaway and Warren Buffett. Danaher was really the one non-Warren Buffett name that caught people's attention. Roper and TRANSDIGM are in that similar category, though Danaher arguably much larger. The acquisition strategy that these companies utilized was unique in that they would go after growth assets that perhaps were not loved within the organization they were owned by, they were perhaps underinvested in, or perhaps they could just get a good valuation on it. They could buy it reasonably cheap. Today, we're faced with extremely low interest rates, and so this business model even makes more sense in many ways today than it even did in the past, whereas you could borrow money for 1%, 2%. We've seen really low financing rates. And if you can earn a 10% return on an acquisition, boy, the spread between that return and your cost of money is really wide and creates a lot of value for shareholders. The key, though, is not to forget that there needs to be some repeatability. I think where a lot of companies got into trouble in the 70s and even in the 80s is that they would do an acquisition and it would work and they'd feel really confident and they'd go out and they'd do an even bigger one without really thinking through all the issues that perhaps of integration, the social issues, perhaps of management, and of course, the competitive dynamics of the business overall. And they would reach for the stars and they'd end up just really falling short. In the case of Roper and TRANSDIGM, and even I throw Danaher in here because it's in a book as well, these were three companies that went out there and had a repeatability of the process around acquisitions, had large pipelines of deals that they could do. They understood where the deal made sense, where it didn't. If it didn't make sense, they walked away. They rarely stretched above some sort of a very conservative range that they built into a deal model, et cetera. So I wouldn't say that the market right now is telling everybody to go out and do acquisitions. I think the market is going to treat each individual case uniquely. Having said that, the growth by acquisition guys have proven to be amazing value creators over time. Again, so if they can repeat the process, it is just shockingly valuable. And frankly, what we've seen in the private equity industry is not much different than what we've seen with the growth by acquisition folks. We do caution that every company should go out there and start doing acquisitions, though, nor should shareholders pressure them to do so. I mean, it's just a limited amount of companies, I think, with the expertise to be able to do it.
Scott, the litmus test for the acquisition is is the incremental return on capital better? Is that the litmus test?
Well, that's the basic. There's a couple different ways to look at it, and there's short-term and long-term dynamics. And one of the best case studies I can think of goes all the way back to 1986, when Jack Welch, who was running GE at the time, bought RCA, which was the owner of the NBC TV station channel, which you know well. And what Jack Welch did is that he turned around, he bought RCA. There were some businesses within RCA he didn't like, and he sold those businesses off for very good prices, actually, because niche assets sometimes find homes in very unique places for good valuations. In that case, it did. And then he took the proceeds that from those asset sales, and he sold his TV business. So he made television sets at the time, and he turned around and he invested in healthcare. And now that's an example of a company that was just pivoting really strongly towards, one could argue, well, you own a TV network, why wouldn't you want to own televisions? Well, Jack Welch's view was televisions is going to be commoditized, not in the short term, but in the long term. He was dead right. In the short term, he felt like, well, the NBC channel may not be incredibly profitable in the short term, but long term, people are going to be watching a lot more television, doing more advertising on television, et cetera, and it's going to be much more profitable. So I think there's a little bit of a push-pull between the long term and the short term, and the focus should always be really on the long term.
Right. Scott, when you mention Roper, it was built by a gentleman called Brian Jellison, who's unfortunately passed away, and he took an industrial pump manufacturer and made it into a software powerhouse. Tell me about that story briefly, if you will.
Sure. Roper's story is my favorite story in the book. And I think because Brian Jellison was such an amazingly unique character. He was so incredibly smart. Some folks didn't like him because he would come off, if you asked him a stupid question, he would just call you out on it and say, that's crazy, that's silly. He had very little patience for folks who didn't have a similar IQ to him. And of course, he was very bright. Brian was an early believer in the power of compounding, which I think is common sense in most constructs today. But at that time, perhaps, the entire concept of doing acquisitions to compound value for shareholders was still a little bit in its early days. Again, even though Warren Buffett had proven it to work, most folks thought that was just Warren, that there weren't other folks who could create that kind of value. And there weren't a lot of folks, to be fair, but Brian Jellison was one of those. And he was an amazing character. He would only do an acquisition where he was incredibly comfortable with the management team, and he always kept the management team. He wanted to be able to fast track the transaction, so he would outsource a fair amount of the real hard due diligence of calling customers and such. He would outsource to a consulting firm so that he could be prepared within 30 days or 60 days to do the acquisition, knowing way more than anyone else who was also potentially bidding on that asset, and oftentimes knowing way more than the folks who were selling the asset. So I think Brian was one of those who won by intellect. So Brian Jellison was one of the first guys, and I remember this 15 years ago, who said to me, software companies are way undervalued. And he was one of the guys, the true visionaries, who said software companies will, he didn't say take over the world the way that Mark Anderson said, but he certainly said software companies will rise in importance to levels that you never dreamed of, Scott. And he said that to me literally 15 plus years ago.
Thanks, Scott. I think he'll definitely be studied as, perhaps a smaller version of Warren Buffett, because he built a conglomerate pretty much in the same fashion that Warren Buffett built it. Unfortunately, didn't live long a life as Warren is living right now. We just have a few minutes left, Scott. So let me ask you, in history they say the decline and fall of the Roman Empire. Can you explain the decline and fall of GE, and is there life after death for GE?
Yeah, GE is the saddest story of our book. And we started in chapter 1 talking about the Jack Welch era, which was designed to be more of a feel-good story. The reality of the last 3 or so years of the Jack Welch era, arrogance crept into the organization. And as we know, arrogance is an amazing culture carrier, or culture destroyer, excuse me. Once Jeff Immelt took over the business in late 2001, of course, you had 9/11 that struck literally the first week he was on the job. The culture was already degrading. His businesses were already showing some signs of that they'd been underinvested in. I think that was unfortunate legacy of Jack Welch. He did underinvest in his businesses his last several years, if not a little bit more. But look, Jeff didn't rise to the occasion. He didn't take the opportunity to say, okay, we need to go back and invest heavily in these businesses. We need to reset earnings at a far lower level because we're going to have to fix our accounting and fix the quality of our accounting. Instead, he did the opposite. He doubled down. He invested more heavily in GE Capital, which of course was the bank part of the business that almost blew up the company when the financial crisis came in 2008. And from a culture perspective, you know, he was flying around with 2 airplanes, as the Wall Street Journal reported. I mean, he was spending lavishly. His reports were spending lavishly. It's very, very hard to drive culture in an organization where executives are acting in an arrogant fashion, in a wasteful fashion. I mean, literally, you want to talk about the opposite of Warren Buffett, you know, who still lives in the home that he grew up in. You know, these folks were just very, very sad. So the GE story, unfortunately, ends with kind of the tragic tale that the businesses were continued to be underinvested in. Acquisitions were done at very high prices. Good assets were sold off, and unfortunately, even today, you know, GE's best asset was its biopharma business that it sold to Danaher recently. Needed to raise cash. It didn't have much of a choice. You know, just needed to raise cash to plug the balance sheet because the balance sheet was a mess.
We're almost. Scott, we're almost out of time. So just a quick answer. Is there life after death for GE? I mean, the stock's down to $6.50 the last time I checked.
Yeah, the stock's at $6 today. Larry Culp is the CEO. Larry Culp, of course, is one of the folks who built Danaher from a smaller company to a much larger company and did an amazing job at taking costs out and bringing culture in. Larry's exceptionally good. So I think a bet on GE here at $6 with Larry Culp as CEO is a very fair bet. I mean, we have to get past COVID, of course, and you know, people need to be traveling again because the aerospace business is critical. But really, you have 3 good businesses there. You know, I think GE will be fine. It's just going to take 2 or 3 years for Larry to really show any signs of turning it around.
Great. Final question to you, Scott. Arrogance, hubris, the longer the monopoly, the greater the decay. It happens to almost all businesses over a period of time. Among the FAANG stocks today, you know, Facebook, Amazon, Apple, Google, Netflix, which one do you think can build the most enduring moat or the most enduring success?
Well, of the names you mentioned, I think Jeff Bezos at Amazon is the one who's the most paranoid about the organization becoming arrogant and complacent. And so probably has the best chance, at least while he's still running the company, of avoiding that. It is inevitable, though. I mean, we have found so few examples of companies that haven't decayed over time, and particularly as arrogance has crept into the organization. You know, the most mature of all of the names out there in tech world, of course, is Microsoft, but it's doing extremely well. So it's reinvented itself. So perhaps each of the tech companies that you mentioned can reinvent themselves and can avoid the ultimate trap. So I'm not sure I could be the one who's going to predict which one is going to be the fail, but I would certainly argue that watch for signs of arrogance, watch for signs of complacency, watch for any signs that they're not investing in their core businesses. Those are all signs that we've seen in the past in industrials that have led to that decay, and that should tell you the tale.
Great. Well, yeah, as they say in Amazon, it's always day one. Unfortunately, we're out of time. It's a great book. I'd urge my viewers to go and take a look at it. Lessons from the Titan, with Scott Davis as the co-author. Thank you so much, Scott, for being a part of Wizards. My pleasure, Ramesh. Take care now.